Hey everyone, welcome to Dr. Frank's Finance World. I am Dr. Frank, the bank, where I try to teach you a little something about finance that you can make some money on in the future. I've got a lot of interest in an options part of this, so I'm going to give you the basic primer on how options work. I'm kind of excited to have done options for a long time and have some pretty cool strategies. Not going to lie to you because I think you can make enough money, and there's some interesting AI in part two of the options paywall. We're going to actually set some of that up as a paywall, but I'm going to give you the basics for now. So an option is a contract between two people. That's exactly what it gives the buyer. You have a buyer of an option and a seller of an option, and the buyer will pay an option premium, which is actually what gives the option value. The person who sells it wants the premium to cover it just in case things don't work the way they want. And so certain things like volatility will feed into the price of what the options contract will be. Realize that if there isn't a seller of an option out there, there won't be a buyer because there won't be an option for the contract. But anyways, between two people gives the buyer the right to buy or sell. A call means to buy the stock essentially, and sell is to push your stock onto them. But you have the right to decide. You can exercise it or not. You will, if you decide to exercise it and get it at the strike price, which is the price that's agreed on the contract. We'll show you what that means in a second. For a set period of time. There are different options contracts times out there these days, from very short to pretty long. But the seller is obligated to therefore make good on the contract. But honestly, they pocket the money about 6 out of 7 times, or at least part of the money. So I'm not going to say per se that an options buyer is a loser's game, but you need to pay attention and do certain things to put in your favor. Otherwise, it's like a scratch lottery ticket. You're just taking a chance out there, right? So the advantage is you can lever up knowledge, hopefully, that you have of a specific situation, or provide protection via put, perhaps of a stock or some equity position you've taken that has gone up in value, and you don't necessarily want to get rid of it, but you see an event coming that might cause trouble, and so you buy the put option as sort of insurance. Anyway, used to speculate and increase risk or to reduce risk. So the question always, from my perspective, is which security? Are we talking about a stock? Are we talking about an index? Are we talking about futures? And then the next question, of course, is why? If it takes specific knowledge to do well, why would you buy it? Why are you getting into it? Are you just gambling essentially and throwing it out there and see what's going to happen? Or do you have some knowledge of what might be happening informationally? So knowledge of the underlying product is super important when you do this. And the question, of course, is what are you expecting? If you expect the price of the underlying security to go up, then you'd want to purchase a call option. If you expected it to go down, then you want to purchase a put option. Realize, of course, once again, that the seller of the option expects the exact opposite of what you do, which is why it is a zero-sum game. The most that the seller of the option will ever make is the premium. That's all they can do. They make the premium and nothing else. Or they make less by eventually handing you back all your premium and then some. But if you lose as an option buyer, the option seller is the gainer in that situation. One thing that you would think in the real world you'd have to worry about is something called counterparty risk. When somebody says, hey, I'll bet you $1 million this, do they really have $1 million and will they make good on it? Is there a contract in place? There is a contract in place when you talk about options, but not every seller has happened what they expect. And in the event that they might walk away, you would have counterparty risk. The Options Clearing Corporation, which is really a combination of the options providers, if you will, the people who settle and do options and all that kind of stuff, are the people who will provide counterparty risk. And thus, if you buy a contract and exchange option and the counterparty, the seller, can't make good, the OCC will. And that's how they eliminate counterparty risk. When we get to the money and banking part of Dr. Frank's Finance World, we'll talk about this, because in the money and banking world, it's typically other banks. And as we've seen in recent history, it is possible for them to go out of business as well. So options contracts have been around a long time. Just to give you a little background information, literally for centuries. Customized options trade in the over-the-counter market out there. OTC over-the-counter market. In April of 73, standardized options began trading on the Chicago Board Option Exchange out there, which is kind of interesting. It's a place you can go and see everything going on, but they have the right, because they're part of the backing up of the counterparty risk, to say what is going to go on. So it's offered by the CBOE, and it's standardized in terms of the underlying common stock. There's a lot fewer options than you would think on stocks out there, or fewer stocks that they write them on. The number of shares covered, it's usually one contract is 100 shares, and the delivery dates and the range of available exercise prices. They have the right to decide it all, because they are part of the Options Clearing Corporation out there that will act as the guarantor, and as such, there are certain conditions they would want to happen when it comes to options out there and so forth, so that they wouldn't necessarily be on the hook for the counterparty risk. They trade on the Chicago Board Option Exchange, the Amex, the Philadelphia Exchange, and others. Options on each of the exchanges are traded similarly, where a typical contract covers 100 shares, and they require secondary transactions if the equity is exercised. In other words, if you exercise your call option to buy 100 shares of whatever, Walmart or whatever out there, the other person has to sell it to you, and that is a separate transaction that has to take place and will cost you money. So you can do it on basic stocks and so forth out there. You can also do it on stock indexes and options and so forth, on exchange traded funds and so forth, which are pretty helpful out there. Anyway, the other index options specifically traded on the CBOE in 1983. There weren't ETFs back then. Relatively inexpensive and convenient way to take an investment or hedge position on a broad-based indicator. They're very popular for people guessing which direction they think the market is going to go. So stock index puts are particularly useful as portfolio insurance. Let's say that you have a ton of money in the S&P 500 or the NASDAQ or something, and you feel that there's some risk over the next period of time. You can actually go out and buy a put. And by the way, all of the index options settle in cash. You can't buy the index per se, or all the stocks. But anyway, it's particularly useful as insurance, because for that period of time that the option is in force, somebody is guaranteeing they will pay you a minimum amount for it. So what does it look like out there? Well, let's go check at recent ones on the S&P 500. So this is today, the 27th of July, 2023, and you can see that the S&P closed at 455 yesterday and some change. It looks like it's going to go up to 458 this morning. More importantly, when you look at down here what's happening, the calls are listed first. The dates that you can buy them are listed. You can see it's pretty extensive when it comes to options out there on large indexes like the S&P 500. You can decide the date that you want to do out there. You can see that the 370 option somebody bought some time ago, I'm sure, for a strike price of 370, and therefore they will have to sell it to you for 370, is worth quite a bit of money, maybe many times what they originally paid for it. But at any rate, there's not much volume in that, and not many that are outstanding as well. When it comes to volume, this is what I'm paying attention to, not the open interest. I want to see whether there's actually activity in these strike prices, because I want to make sure I have some liquidity. Volume, a sufficient volume, will actually provide the liquidity to be able to get out of the option by selling it to somebody else when you're ready to get out. Not everybody wants to hold it to maturity, and therefore it's important that you watch volume. It's one of the things we'll talk about too. So you can see these are going to expire at close of New York time today, 4 p.m. New York time today. So it's only a one-day option. You can see if you watch the volume as we get closer and closer to strike prices that are close to this 455, what it closed at yesterday, you will see that the 455 one is in the blue because it's in the option, in the money. You could force somebody to sell this option to you for the S&P for the ETF actually for $455, and you're going to pay $1.70 to do so. But look at what happens to the volume as you start to get close to at the money and in the money, or just slightly out of the money option. You can see many more trade around those time periods. So I call these on the run. These are the options I tend to focus on because I don't want to deep out of the money. Look at it like this. I don't know who would be out here buying 471 options, which would be a 454, what is that, $17, about a 4% move today. I wouldn't expect that to happen, but you can see some people apparently are trading much further out than that. And as you can see, they get down to just pennies per contract per share because the odds of them paying off are not very good. You can go down further and see the put options as well. And all of these options, you're forcing somebody to sell it to you to buy your shares for 370. Why in God's green earth would you want to force them to buy it for 370 when you can turn around right now and sell it in the market for 455? So these are in the money because you're forcing somebody to buy your shares for more than the current price. And these are out of the money, and you can see they get pretty cheap pretty fast too. And you can see how quickly or how much the volume grows around the in the money, at the money options for puts as well. So anywho, the first trade out there, just a little look at what's happening with the S&P 500 and so forth. Here's one I took a few months ago on the 20th of April. It was a one-day one too, I believe, as well. And you can see that the at the money the index was trading at 414 at the time. The 414 were not very expensive out there. You can see that there were a ton of contracts traded because people knew they'd only had to get to 415 essentially for you to break even on it. Anyway, it's just interesting to see that the further you got out of the money, the less volume there was, and the price dropped precipitously because there wasn't much time to make up for the stock having a chance to go up. As you can see from the change on this day, apparently the market was down on April 20th and a number of the options were off. You can see some of them were down 80% in one day. So it's possible to win or gain a lot, but it's also possible to lose a lot. The put side of the same day looked like this. You could force somebody to buy it from you at 414. It's really, this is right as the market was closing, so it's a little bit off. But anyway, these were in the money. You can see these were down as well. Probably not so much that the market was up or down, but as much as you were looking at very little time value left for something to happen. So things that matter, the longer the time until the option expires, the higher will be the price of the premium. The strike price, it varies on whether it's a put or call, and we'll talk about that, where the strike price is relative to the regular price. But volatility of the underlying security, the more volatile it is, the higher the price as well. And then we can look at implied versus calculated. Implied just says this is what the price would be if it made sense to people mathematically based on the five things that impact the value of an option. Well, I actually go out and calculate it, and I'll show you this if you jump to the paywall side of it, how I go about in Excel and calculate that. I also look at the probability of payoff. The security price does matter as well. Other factors to keep in mind, option volume or the lack thereof will haunt you if you're not careful. And the intrinsic value is what you could sell the option for, or let me rephrase that, exercise the option for right now and make money off of. All options that have time, the premium will be a combination of intrinsic and time value. As long as there's still some time left for that option to move, you will have a combination of both and have some time value. We'll talk about this problems in part 3 to go over this in case you have tests on it. In the money could execute immediately and make money. This would be true when the stock price was above the strike price. In other words, strike price of 30, current price on the call of 35. You could make somebody sell it to you for 30, turn around and sell it for 35. So it is above, and therefore you would be in the money. And it is below for a put is when you're in the money as well. So out of the money, you cannot execute and make money. It may still have value because there may be time left, but all the value of the option, if it's out of the money, is strictly time value because you can't execute it and make money immediately. Option premium is made up of the combination of that. Excuse me. When out of the money, all time value. We can look at math in the previous slide, but we'll pick that up in future parts of the option stuff. So don't forget to send emails and comments to Dr. Frank's Finance World at jbawealth.com. Anyway, email me if you have any questions, and I look forward to talking to you in part 2. Have a good day. Bye-bye.